Point that yet again American taxpayers find themselves forced to pay billions of dollars in bailouts. Only this time we are not bailing out profligate American companies but foreign governments. Billions of dollars of IMF funding, much of it coming from U.S. taxpayers, will be sent to Europe to bail out Greece and other European countries who might find themselves in financial crisis. Evidently, the lesson of the U.S. government bailouts has not been learned. Bailouts do not, in fact, cannot make things better. They can only make things worse. Governments can pay for bailouts by increasing taxes, which takes money out of the pockets of hardworking, poor, and middle-class Americans and siphons it off into the bank accounts of failed bankers. Or governments can pay for bailouts through inflation, increasing the supply of money out of thin air and devaluing the currency. In this case, the bailout firms who have used this new money to reap all the benefits, while the poor and the middle class see increased prices and the purchasing power of their savings reduced. Finally, governments can pay for bailouts through increased issuance of debt, increasing the tax burden of future generations in the hope of finding investors who will purchase bonds which are increasingly unlikely ever to be paid off. None of these options lead to long-term stability. They merely attempt to patch up a fragile financial system and put off financial reckoning until the next crisis. Bailouts provide a short-term illusion of continuing prosperity, while underneath the same rotten fundamentals ensure that bailout money is merely throwing good money after bad. Bailing out foreign governments is just as bad. Why should American taxpayers be on the hook because a foreign government cannot cover its debts? What makes this situation even worse is that the bailout is being undertaken in a manner which is nearly impossible to stop. Bailout funds coming from the IMF, which receives nearly 20% of its funding from the United States, require the approval of IMF members, including the United States, with its de facto veto power. Only the president can prevail upon the U.S. representative at the IMF to vote against this bailout. The people and their constitutionally elected representatives in Congress are shut out. Compounding this is the reemergence of dollar swap lines from the Federal Reserve to foreign central banks, which will likely result in the creation of tens of hundreds of billions of dollars of new money. Bailouts never work. They never have, and they never will. The only thing they do is burden the taxpayer and delay the inevitable collapse of the bailed out entity. Fiscal and monetary responsibility is a tough pill to swallow, but it is essential for the sound functioning of the economy. We need to end the cycle of bailouts and ensure that American taxpayers will not continue to subsidize foreign governments. And I yield back the balance of my time.
Thank you, gentleman, for his opening statement.
I want to follow up on the discussion about whether or not this is a bailout, because as was stated earlier, most Americans see this as a bailout. We obviously are committing funds. I mean, I estimate it must be up to close to $60 billion that we've committed one way or the other. And if it wasn't a bailout, they wouldn't need us. What is the purpose? If they didn't need help, if they didn't need bailed out, they could just go to the market and borrow money. But they lost all their credit rating. Nobody wants to loan money to Greece, so they have to be bailed out. And I think that is a proper term. But you say, no, well, we're going to get them on their feet again, and they're going to pay back, and we're going to make profit at it. But, it's the other side of this is, what about the people who don't get bailed out and get help? Think of all the small companies in this country. Think of the people who were just about under with their mortgages, if they just had help for 6 months and get back on their feet again. But no, they don't get the help. The big banks and the countries get this, and this is why the people see this as so unfair. I see it as a very unfair system as well, but one that is not constitutionally oriented. Because if we commit monies, especially on these swap funds, swap arrangement, currency swaps, I mean, these are monies. I know it's traditional. I know it's accepted, but Congress doesn't appropriate this money. They don't authorize this money, and it's big money. It's really big money. So I don't see how we can avoid calling this a bailout. There was a time in 79 and 80, our dollar was, in trouble, and other countries came, and the IMF bailed out our dollar and made these arrangements. But it's always because it's too big. if we don't bail out the big guys, if we don't bail out these sovereign nations, if we don't bail out these banks, because we're really bailing out banks here. They're the ones who have made these loans. So I'd like to have you further defend this idea that it isn't a bailout, and I'd like to know also what kind of collateral we're going to get on these swap arrangements. They say we have collateral. Well, what kind is it going to be? You know, we have collateral with all this money we gave our banks. It was these illiquid assets. You know, these derivatives, these housing mortgages nobody else wanted. Oh, yeah, we got these assets, and they're all in the books at the Fed. But this is so unfair because it's done with increase in the money supply, and it's a burden on the taxpayer. So once again, see if you can convince me that this is not a bailout, and convince the American people. You know, try to talk to somebody who didn't get help on their mortgage, or a small businessman that was out of business and didn't get treated as well as we treat these foreign sovereign nations and these foreign banks who made loans to these governments.
So, Congressman, let me say first that Federal Reserve is not providing any money to Greece. We're not providing any liquidity. We're not providing any other assistance. What we have done is to say that we will, in short-term swap arrangements, provide dollars to the European Central Bank.
And you get what?
And we get euros at the prevailing exchange rate for those dollars, and then the arrangement gets unwound at the end of, if it's an 8-day arrangement, as one maturing today.
Why is that necessary? Why don't they just use the euros? If it's equal, if it's an equal trade.
It's necessary, Congressman, because you have institutions in Europe which have lent dollars, for example, and which are in need of funding in dollars. It may be, and often is, a perfectly good transaction to have entered into. But as conditions become very tight because there's a lot of uncertainty about the availability of dollars, then, as we saw a couple of years ago, even an institution which has been well run and has been careful in taking on exposures may not be able to get that dollar funding in the short term. But that is why we offer this liquidity swap only at a penalty rate.
And where do we get the dollars to give them for the euro?
It is created as a reserve and then unwound when it comes back, as they did during the financial crisis. But I just want to say one other thing, Congressman, which is that the reason we're doing this is precisely so that we forestall the potential for the generalized freezing up in credit markets, which will constrain or would constrain our own large institutions, which in turn would constrain their ability to lend to American businesses and American households. And I would say that at this moment, when after a period of watching lending standards tighten for quite some time and then simply not relax at all, particularly for small businesses, we're finally seeing some indications that those standards may be relaxing, that we may be able to start increasing lending to small businesses again. And I think this is the moment where we really do not want a substantial external shock to our financial system to undo the progress that we're making in that direction.
If I may ask one quick question. What happens if the euro loses 50% of the value? Are the taxpayer, is the dollar at risk there? Do we lose something then?
The European Central Bank is still obliged to pay us back the number of dollars that they drew originally. Market risk rests with them,
but
not with us.
We're holding the euros.
Gentlemen's time has expired. And before we close this panel, I'll go to the